This is today's Daily Market Comment by Mario Sajikiriakos. I'm Christina Marujos, and thank you for joining us at xm.com. The Bank of England hit the panic button on Wednesday, announcing it will step into the UK government debt market to buy £65 billion in bonds over the next 2 weeks to restore stability. Yields on UK bonds had gone through the roof in recent days after the government ruled out a budget that contained unfunded tax cuts, sparking debt sustainability concerns. It was the threat of financial contagion that really forced the Bank of England to intervene, amid reports that the implosion in the bond market was chipping away at the collateral held by institutions such as pension funds, raising the risk of insolvency and more forced selling of bonds to raise cash. To stop this domino effect, policymakers will inject billions of pounds into the system by buying longer-dated bonds. This process will add fuel to inflationary pressures, but the Bank of England didn't have any choice. It had to act to prevent a deeper crisis. As for the pound, this is a net negative development. Global bond yields came crashing down in the aftermath of the intervention, which came as a breath of fresh air for equity markets. Investors interpreted the Bank of England's move as a signal that if push comes to shove, systemic risks threatening the financial system override inflation concerns, forcing central banks into action. The S&P 500 rose by nearly 2%, although this recovery was rather underwhelming, considering just how massive the retracement in yields was. Futures suggest most of this rebound will be wiped out when markets open today, pushing Wall Street towards its recent lows. It will be hard for those lows to hold because, from a valuation perspective, the market is still too expensive. Over in the FX arena, the US dollar surrendered some ground across the board as rate differentials compressed to its detriment and safe haven demand for the reserve currency dried up. The striking part was that the yen was the second worst performer yesterday. Soaring yields across the world have inflicted serious damage on the Japanese currency this year, so when those yields retreat so dramatically, one would expect the yen to benefit the most. This is a bad omen for the yen. When a currency cannot shine on good news, it is unlikely to shine at all. With the Bank of Japan refusing to consider higher interest rates and last week's FX intervention failing to accomplish much, dollar-yen seems ready to take another stab at the 145 region. Thank you for watching today's Daily Market Comment here at xm.com.